What if everything you believed about money and wealth was an illusion carefully engineered by a system most people barely understand? What if the prosperity you see on the surface, the booming stock markets, rising real estate prices, and unprecedented consumer spending was not a sign of real value, but a meticulously constructed mirage? What if the institutions we trust to maintain financial stability were in fact architects of a carefully controlled illusion? To understand this, we have to go back centuries. The concept of money has always been tied to trust, but the way that trust is manipulated has evolved dramatically. In the early days, money was tangible: gold, silver, and other commodities with inherent value. These metals were scarce, difficult to forge, and widely accepted. The first coins were stamped by governments not just to facilitate trade but to assert authority. Whoever controlled the money supply controlled the economy. The real transformation began with the emergence of central banking in the 17th century. Institutions like the Bank of England, founded in 1694, were initially intended to stabilize economies, fund wars, and regulate currency. But over time, central banks discovered a far more powerful tool than coins or paper money: the ability to create money out of nothing. They realized that by controlling credit, interest rates, and liquidity, they could manipulate entire economies. This is the moment the illusion of wealth was born. At first, this control was subtle. Banks issued notes backed by gold, promising that paper could always be exchanged for a fixed quantity of metal. Yet even then, fractional reserve banking allowed them to lend far more than they actually held. Wealth appeared to grow faster than reality. Economies boomed, stock markets soared, and citizens assumed prosperity was real. But beneath the surface, the gap between appearance and reality widened. By the 20th century, central banks had perfected the art of monetary illusion. The gold standard was abandoned during the Great Depression and later completely dropped in 1971 by the United States. Suddenly, currencies no longer represented real assets. They were fiat money, valuable only because governments declared them so, and citizens agreed to accept them. Central banks now had unprecedented power to influence economies through interest rates, quantitative easing, and complex financial instruments. The illusion of wealth could be expanded almost limitlessly. But every system has a breaking point. During the Great Depression, the world experienced what happens when the illusion falters. Banks failed, savings disappeared, and millions faced economic devastation. Governments intervened with large-scale spending programs, bank bailouts, and monetary policy adjustments. These interventions seemed to work, restoring a sense of security. But they also reinforced the central bank's hidden power. They were now both the cause of instability and the source of its remedy. In the post-war era, central banks expanded their reach further. Bretton Woods attempted to stabilize global currencies by pegging them to the US dollar, itself backed by gold. This temporarily anchored value and created a perception of stability. But by 1971, the dollar was freed from gold entirely, and the illusion of wealth became entirely abstract. Central banks could print money by government debt and inject liquidity into markets without any real limitation. What appeared to be prosperity was increasingly divorced from real assets or productive output. The fallout of this system is subtle but profound. Stock markets can soar even as wages stagnate. Real estate prices can climb even as household incomes fail to keep pace. Governments can borrow trillions while citizens remain oblivious to the true cost: inflation, hidden taxes, and the erosion of purchasing power. Every crisis from 2008 to the COVID-era stimulus programs has reinforced the pattern. Central banks intervene, inject money, stabilize markets, and restore the illusion of wealth, but the underlying imbalance remains. Debt grows, inequality rises, and the system becomes increasingly fragile. Even today, the strategies are more sophisticated than ever. Quantitative easing, low or negative interest rates, and massive asset purchases create a perception of liquidity and prosperity. Inflation-adjusted wages often stagnate, yet consumer confidence may rise because markets are performing well. Housing prices reach record highs, yet borrowing continues, as if wealth were genuinely increasing. The repeating pattern is unmistakable: create liquidity, inflate asset values, stabilize markets, prevent collapse, repeat.
Meanwhile, the underlying real economy often lags behind the illusion. Data reveals the scope of this phenomenon. Global debt now exceeds $350 trillion.
Wealth inequality is at historic highs, with a small elite capturing disproportionate gains from asset inflation. Stock markets reach record peaks while median wages remain stagnant. Housing affordability is at crisis levels in major cities worldwide. And yet central banks are hailed as saviors every time a crisis looms. This is the repeating pattern of engineered illusion. The appearance of prosperity maintained through monetary control rather than real economic growth. What are the lessons we can take from this hidden system? First, wealth can be manufactured through perception, not production. Stock market gains, rising asset prices, and GDP growth can be illusions orchestrated by monetary policy rather than genuine value creation. Second, debt is both the tool and the trap. Central banks rely on the constant expansion of credit to maintain the illusion. And individuals, businesses, and governments all become participants in the system, often unknowingly. Third, historical patterns repeat. From the gold standard collapse to modern quantitative easing, the mechanisms of control and the cycles of boom and bust are remarkably consistent, offering clues to those who study them carefully. The warning is clear. The next time markets surge, housing bubbles expand, or government spending appears limitless, remember that much of what you see may be engineered perception rather than real prosperity. The illusion of wealth is fragile, and those who understand its mechanics can navigate it more safely. Protect real value and avoid being blindsided by the next systemic shock. The broader question remains, if central banks have the power to shape perceptions of wealth, how much of what we consider financial success is truly earned, and how much is carefully engineered? Awareness is the first step toward reclaiming control. If this exploration of monetary manipulation has opened your eyes, subscribe and turn on notifications. The secrets of how wealth is engineered are deeper than most imagine, and understanding them is not just about curiosity, it's about protecting your financial future.